Welcome to Iron Financial. Our mission here is simple. We help you forge a stronger portfolio. We do that by running companies through a structural stress test to cut right through the market weakness and noise. Today, we are putting Oxford Industries, ticker OXM, right under the microscope. Now, this stock has been absolutely pulverized, and we need to find out why. Is this just a temporary fracture that can be mended, or are we looking at a catastrophic, unfixable structural failure? We need to know, has this company's foundation finally cracked under pressure, or are they in the middle of rebuilding it, stronger than ever before? Let's dig in.
Yeah, that's really what it all boils down to, isn't it? I mean, when you see a stock get hammered this badly, it creates this huge conflict for investors. And it always comes down to one critical question. Is this business fundamentally broken? Is it a value trap just waiting to snap shut on anyone looking for a bargain? Or is this a massive once-in-a-decade turnaround opportunity that the rest of the market is just too terrified to touch? So today, that's our job. We're going to put this company through the ringer and see what's actually left standing when the dust settles.
Okay, let's get right to the catalyst. The alarm bells didn't just ring, they screamed bloody murder with the fourth quarter earnings report. You see, Wall Street, they were expecting a small but positive profit of about 5 cents per share. But what did Oxford deliver? A loss of 9 cents per share. Now let's be perfectly clear, that is not just a miss, that's a 280% negative surprise. For a company that lives and dies by consumer spending, a miss of this magnitude, it's not just a number on a spreadsheet, it's a complete and total shattering of investor confidence. It's a seismic shock, and that shock is exactly what triggered our investigation into this company's structural integrity. This right here, this is the first visible crack on the surface.
Man, look, I get it. Any company can have one bad quarter. That's not a death sentence, not by a long shot, especially in the retail world we're living in right now. But you always have to zoom out. You have to ask yourself, is this just a little pothole in the road, or is it a giant sinkhole that's about to swallow the entire highway? And when we zoom out and look at the full year picture for Oxford, it becomes painfully obvious this wasn't just a bad 3 months. The whole year looks like a complete demolition job was done on their profitability. It's a shocking journey from solid black ink straight into a deep, dark sea of red.
Just look at the sheer scale of this reversal. We are not talking about a little dip in profits here. We are talking about a complete inversion of their entire financial reality. Let this sink in. In fiscal 2024, Oxford Industries booked $93 million in net earnings. That's a healthy, profitable, solid company. Now, fast forward just 12 months. That $93 million profit has completely evaporated. It's gone. And in its place, a nearly $28 million net loss. If you do the math, that is a total swing of over $120 million to the negative in a single year. This is the kind of financial wreckage that absolutely demands a forensic examination. We have to figure out what happened.
So, that brings us to the crucial question. How on earth does this happen? How does a nearly $100 million profit suddenly become a $30 million loss? To understand if this structure can even be saved, we have to perform what is essentially an engineering analysis. We have to pinpoint exactly what broke. And our team has identified 4 primary points of failure, 4 distinct stress points that, when combined, cause this entire collapse. We're going to dissect each one of them, piece by piece, to really understand the extent of the damage. This isn't just about the numbers you see on the surface, it's about the underlying causes. So, let's start with the biggest, most damaging blow.
$61 million. I want you to burn that number into your memory. This was a single massive charge that acted like a wrecking ball to the company's bottom line. Forget everything else for a second. Forget tariffs, forget sales figures, forget brand performance. This one event, the $61 million hit, single-handedly obliterated their profitability for the entire year. You could say it's the epicenter of the earthquake that shook this company's financials right down to its core.
Okay, hold on a second. Non-cash impairment charge. That is the exact kind of accounting jargon that makes a regular investor's eyes just glaze over. We got to break this down because it sounds really, really important. Is this just some kind of fancy bookkeeping trick, moving numbers around on a spreadsheet to make things look different than they are? Or is this a giant flashing red light that signals a real, tangible, catastrophic business failure? I mean, what does an impairment actually mean for someone who owns this stock? Because it really sounds like they're just admitting to a major, major screw-up.
It's not just a signal of a screw-up, it's a confession. An impairment charge is a company's formal, public admission that an asset on its books is no longer worth what they said it was. It's an oops. And in this case, that asset was the Johnny Was trademark. Let me put it in plain English. It means they either massively overpaid for the brand when they bought it, or they have mismanaged it so badly since the acquisition that its value has absolutely plummeted. You can pick your poison, but either way it represents a $61 million direct hit to shareholder value. It is a massive crack in their entire capital allocation strategy.
All right, now for the second point of failure. This one isn't an internal misstep. This is a relentless, crushing external pressure. In fiscal 2025, the company got hit with $30 million in tariffs. Now, that's already a significant drag on profits. But the real problem, the scary part, is what you see on the right side of this chart. For fiscal 2026, they are guiding for that number to jump to $50 million. This isn't a temporary storm that they can just wait out. This is a permanent, growing, $50 million anchor that they have to chain to their business and drag into the future.
Whoa, wait a minute. So let me get this straight. You're telling me the single biggest anchor that's already dragging down their margins is about to get $20 million heavier next year? That's not just a problem, that's an accelerating problem. That's an incremental $20 million headwind that goes straight to the bottom line, wiping out profits before they can even make them. How in the world does an apparel company, a business that lives and dies on its margins, how does it absorb that kind of escalating pressure? It's not just a crack anymore, it's a crushing weight being added to an already weakened structure.
And you know that pressure isn't being felt evenly across their entire portfolio of brands. And that brings us to the third point of failure. You look at their two core, what I'd call their load-bearing brands, Tommy Bahama and Lilly Pulitzer. They're showing some wear and tear, for sure, down 4% and 1% respectively, which isn't great, but it's understandable in this tough consumer environment. They are bending, but they are not breaking. But then you look over at Johnny Was, down 20%. It's not just underperforming, it's in an absolute freefall. It's a dead weight, and it's dragging the entire portfolio down with it. This right here, this confirms that the impairment charge wasn't just some abstract accounting entry. It was a reflection of a real, ongoing operational disaster.
And just to pile on, because why not, it turns out it wasn't just their own brands that were failing them. They also got hit by a counterparty collapse. They had to take a 19-cent per share charge because one of their major wholesale partners, Saks Global, went bankrupt. So let's recap. On top of the massive self-inflicted wound with the Johnny Was acquisition, and on top of the crushing external weight of tariffs, their actual sales channels are proving to be unstable. It just raises these really serious questions about the durability of their whole wholesale business model. You have to wonder, is this a one-off bad luck event, or are there other weak links in that chain just waiting to snap?
Okay, so that is the damage report. And let's be honest, it is extensive. But our job here at Iron Financial isn't just to document the wreckage, it's to analyze the blueprint for the rebuild. So now we shift focus. We've seen all the points of failure. The crucial question becomes, does management actually have a credible plan for recovery? Do they have the right tools, the right materials, and the right strategy to not just repair this structure, but to make it stronger for the future? Or are they just slapping some plaster over the cracks and hoping no one notices? Now, to understand their rebuilding plan, you first have to understand the existing structure. And this chart says it all. Just look at the size of that Tommy Bahama slice. This is not a diversified portfolio of equal partners, not even close. The entire Oxford Industries enterprise rests squarely, almost entirely on the foundation of the Tommy Bahama brand. It is the primary load-bearing wall of this entire company. Its performance isn't just important, it is everything. The success or failure of any recovery plan they have begins and ends right there.
And you know, to be fair, this right here is probably the most compelling piece of evidence in their favor. The main pillar is showing real signs of strength. According to their own commentary, after a really tough year, Tommy Bahama's comparable sales actually flipped to mid-single-digit positive growth late in the fourth quarter, and they said that momentum has continued. Now, for anyone who doesn't know, comparable sales just means sales from stores that have been open for at least a year. It's the best measure of a brand's core health, and it's positive. That's a huge green shoot. But is it enough? Can one strong brand, one single load-bearing wall, truly carry the dead weight of a failing acquisition, crushing tariffs, and a shaky wholesale channel? That is the multi-million-dollar question right there.
Well, management argues it's not just about one brand. They would tell you they are actively reinforcing the company's entire operational backbone for the long haul. And these are two critical strategic moves they've made. First, sourcing. They have aggressively rerouted their supply chain away from China, taking their exposure down from a 40% run rate to just 15%. This is a direct structural response to that growing tariff problem. Second, infrastructure. They finally completed their massive new distribution center in Lyons, Georgia. Now, while a project like that won't pay off tomorrow, it is a huge long-term investment in efficiency and durability. They are absolutely attempting to re-engineer the company's core operations to withstand future shocks.
Now it is time for the ultimate stress test. We've looked at the income statement. We've analyzed the operational plan. It is time to examine the financial foundation itself, the balance sheet. And what we find here
is a massive contradiction. It's a fundamental conflict in how they're allocating their capital that pits a huge, and I mean huge, increase in debt directly against their unwavering commitment to shareholder payouts. This, right here, is where the bull case and the bear case for this stock collide head-on.
This, folks, is a major stress fracture on the balance sheet. At the end of fiscal 2024, the company had a very manageable $31 million in long-term debt. Okay, no problem. Just 1 year later, that has exploded to over $116 million. It has more than tripled in a year. That severely constrains their financial flexibility. It increases their interest expense, which eats directly into any potential profits, and management has now stated that paying this debt down is a top priority. This is a significant financial burden that essentially starves the rest of the business of the capital it desperately needs to fix its other problems.
A burden, yes, a massive one, I agree. But then you have this number. 56. In the face of that soaring debt, in the face of collapsing profits, in the face of the Johnny Was disaster, what did the company do? They relied on their history. This number, 56, it represents something incredibly powerful to long-term investors. It's a commitment that the bulls will point to as the ultimate sign of confidence and durability from the people sitting in the boardroom.
And there it is, straight from the CEO, Tom Chubb. He said, and I'm quoting, "We believe paying a dividend is important and have paid one every single quarter since we went public in 1960. And you know what? They didn't just pay it this time, they actually raised it." So right here is the core conflict for anyone looking at this stock. Is this 56-year track record a sign of incredible, long-term institutional strength? Is it a testament to their unwavering confidence in a full recovery? Or is it a sign of absolutely reckless capital allocation, funneling precious cash to shareholders that should be used to pay down that growing mountain of debt? Is this strength, or is this just pure hubris?
So we've run the stress test. We've dissected the profit and loss statement, we've analyzed their operational game plan, and we have pressure tested the balance sheet. It is time. It's time to weigh all of the evidence and deliver the final verdict. Based on everything we have seen, is Oxford Industries a generational buying opportunity born from irrational fear? Or is it a classic value trap just waiting for investors who ignore the deep cracks in the foundation?
All right, let's lay it all out. The bull case, this idea of rebuilding on strength, it's compelling. The momentum that we're seeing in their core asset, Tommy Bahama, that's real and it's tangible.
But the bear case would argue that it doesn't matter one bit when you have a $50 million tariff anchor that is getting heavier by the day, not lighter.
That's true, but you have to remember their major capital spending cycle is peaking. That is going to free up a significant amount of cash flow in the coming year. That's cash they can deploy.
Cash that's already spoken for by that soaring debt load. That debt creates an immense amount of financial risk if that Tommy Bahama turnaround stalls for even a single quarter.
But management has explicitly made debt reduction their number one priority, and you simply cannot ignore that 56-year dividend history is a powerful signal of their long-term confidence. They are betting everything on the core of the business.
A bet that seems to ignore the facts on the ground. The $61 million write-down proves Johnny Was a failed, value-destroying acquisition. And their overall margins are deteriorating under all of this combined pressure. The foundation itself is just not stable.
So it all comes down to this. Our stress test reveals a company that is under immense, almost unbearable pressure. It has a foundation that is clearly cracked from the failed Johnny Was acquisition, and it is shouldering the heavy and still growing burden of tariffs and debt. They are walking a financial tightrope with almost no room for error. And so everything comes down to one single question. You have one strong pillar, Tommy Bahama, that is showing renewed strength. But can that single pillar truly support the immense weight of all the other failures? Can it bear that load long enough for management to repair the rest of the crumbling structure? That is the bet you are making if you invest in Oxford Industries today. The risk is that the pillar buckles under the weight. The reward is that it holds just long enough for the entire foundation to be forged anew. The choice is yours.
Disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.